Investment banking is evolving rapidly, in particular in the areas like technology, market risk, and trading operations. As the business analysts who work in this area, your role is so crucial in helping managing the financial risk and leveraging cutting-edge technology for better decision making. But let's be real here, a lot of business analysts can struggle to keep up, which unfortunately can lead to the big mistakes which can cost millions of dollars. So in this video, I will break down the top mistakes that business analysts do in the investment banking and what you need to do in order to stand out as the expert in this fast-moving industry. And if you're new here, I'm business analyst, I'm working in investment banking, and I'm also MBA and CQF qualified. So one of the biggest mistakes can be misunderstanding the market risk. In particular, this would refer to the business analysts who work closely with the market risk team. Market risk is the heart of the trading and the investment banking. Whether you are dealing with the equities, fixed income, forex or commodities, bank will rely on the business analyst to interpret risk models to assess the potential losses. However, one of the biggest mistakes that analysts can do is to blindly just trusting the model without understanding their limitations. And if you fail to account for a fatal risk event, for example, that happened during the financial crisis in 2008, that you can underestimate the potential losses. And how to avoid those mistakes. Learn about market risk methodologies if you are closely involved in your work with the market risk team. You need to understand what is the value at risk, shortfall events, stress testing. Actually, most of those methodologies I learned when I was doing my studies in Certificate for Quantitative Finance or CQF. But this one is a bit pricey, and if you are a student or maybe just starting your career as the business analyst in investment banking, then there's so many online platforms and resources available for you to explore and learn about the market risk. Another important step here is to stay updated on the market shock. You need to follow real-time updates. For example, if there were any changes to the interest rate, geopolitical risk, volatility spikes, and how they actually can influence or impact the risk models. Technology is transforming how investment banking, managing the risk, and execute the trades. Yet many business analysts, they fail to understand the tech behind trading system, and that's a major mistake. For example, if you're working closely with the trading desk and they are using the automate system to execute the trades. However, if you don't have a good understanding of that system, and let's say in particular when the order is executed in the particular price, and if there will be issue like delay in executing the trades, that you could be missing here potential, a critical insight, how this can impact the profit and the risk. So how you can avoid this mistake? So firstly, get familiar with the market data system. So for example, maybe you can get access from the department where you're working to the platform like Reuters and Bloomberg and learn about the Python-based market analytical tools. And try to stay ahead with the emerging technology. If you want to be valuable in the investment banking, you definitely need to bridge the gap between technology and banking. Because of good business analysts who are working in the market risk technology department can easily explain the trading engine systems. The third mistake is misunderstanding the business requirements and passing the wrong information to the development team. One of the biggest and one of the most common mistakes that business analysts can do in investment banking is to fail correctly translate the business requirements and pass wrong documentation to the developers. This can lead to the incorrect system updates, trading errors, and serious operational risk. So for example, let's say trading desk is looking to implement a new stop-loss feature which will automatically exit the trades at the specific requested price. And in this scenario, business analysts misunderstand the business requirements and they tell developers to implement this feature based at the daily close price instead of the real-time execution price. And as the result, if this wasn't correctly tested and it went to the production, so this can lead to the massive losses if the market moves unexpectedly. So how to avoid this mistake? Firstly, ask detailed questions. Never assume that you understand perfectly the business requirements from the first time you met with your stakeholders. Every time after each of the meeting that you have been seeing or talking maybe to the trading desk or risk manager, make sure you document any new requests and then pass them back to your stakeholders to confirm that your understanding was correct. Write a clear and precise user stories. Use a real-world trading scenarios in order to avoid any misunderstanding in the future. And of course, test before deployment. Always work to simulate the test scenarios and work closely with traders and developers before implementing or deploying anything to the production state. So as we have seen today, business analysts play a crucial role in the investment banking, ensuring that the risk models, technology updates and trading systems run smoothly. But small mistakes can lead to the significant financial losses. And if you enjoyed this video, you might also like this one, and please don't forget to subscribe if you haven't yet. And thank you very much for watching me, and see you in the next video.